Hey, what's up guys? John here. Big bank bail-ins are going to happen. I'm talking large banks, the big ones, JP Morgan, Bank of America. A lot of these big banks I think are going to be in huge trouble. And so if you have all your money in one of those banks, you should digest this information and make sure that you're making the right decision to keep your money there. Now, I myself am going to be moving money out of some of these banks and putting it somewhere else. The reason for this is because I think we're stepping into an environment in which we start to see bail-ins occur left, right, and center. I mean, it's legal. People don't realize that they can bail themselves out of a bad situation with your money, with my money. And so because of that, I'm going to make other decisions. I'm going to walk you through what's really going on that nobody is talking about. I'm going to leave all of the notes, all the references pinned in the video description in the show notes. So you can click it, you can explore it, drop your comments below. We'll talk about this. This is absolutely insane. And I think we're stepping into unprecedented times. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on. And if you want to fix your credit to potentially do a balance transfer, get out of high interest credit card debt, you want to position yourself in the strongest light before the chaos, we'd love to help you at GreatCreditFast.com. That's GreatCreditFast.com. Give us a call at 561-430-5900. Take a look at this. So bank bail-ins are legal in the U.S. This was signed into law in 2010. Obama signed it into law. So about 13 years ago, we accepted this. And so this allows banks to basically do, a little bit more risky behavior because at the end of the day, we are the insurance policy on that behavior. Ken Griffin came out, the wealthiest hedge funder in America, made about $2 million an hour in 2022, about $2 billion in income. He said that consumers have about $1 trillion and they're burning about $100 billion a month. And he said that leaves them on track to exhaust their pandemic cash hoard in a matter of months. And so, while this is happening, we're stepping into a more expensive world. Everything is much more expensive. People are spending like, it's 2015. Like everything's great. But as they continue to increase interest rates, this is going to put extreme pressure on banks because banks are sitting in a situation in which they've issued tons of loans on residential and commercial properties, auto loans, credit cards. All of these loans are going to become more and more risky by the day. And as that's happening, bank deposits are going to start to get diminished. And as that is occurring, the foundation that banks sit on is going to start to crack. We're already starting to see it with the SVB Bank, Silvergate Bank. We're starting to see a lot of crypto exchanges. A lot of weakness is coming to the financial sector. So right now, at the end of 2022, 18.3 million borrowers in America are behind on their credit card. 18.3 million. Auto loan delinquencies are rising. Here's what to do if you're struggling with payments. But this is on the FDIC website. This is very fascinating. I talked about a situation here with credit risk, talking about commercial lending, saying that this is going to be a huge problem with commercial loans. The reason for this is lower occupancy rates, which is expected to reduce rents, operating income, affected office properties. At the same time, interest rates would be expected to make it more expensive to refi loans when they come due, right? I've been talking about this. 1 out of 3 loans on commercial properties in America is on one of these, on commercial properties. Like that is absolutely crazy. We went from 3% interest rate to a 7%. And Jerome Powell, he's going to continue increasing rates. It looks like we're going to see a lot of credit risk in commercial real estate throughout America. And the depositors are going to be the ones that are going to be on the hook for that. But take a look at this. So interest rate risk, the current interest rate environment has had a dramatic effect on the profitability and risk profile of banks' funding and investment strategies. First, as a result of the higher interest rates, long-term maturity assets acquired by banks when interest rates were lower are now worth less than their face value. The result is that most banks have some amount of unrealized losses on securities. The total of these unrealized losses, including securities that are available for sale or held to maturity, was about $620 billion at year-end 2022. Unrealized losses on securities have meaningfully reduced the reported equity capital of the banking industry. The good news about this is that banks are generally in a strong financial condition and have not been forced to realize losses by selling depreciated securities. On the other hand, unrealized losses weaken the bank's future ability to meet unexpected liquidity needs, which is what we're going to be stepping into when the banks continue to run into a difficult situation when their deposits start running low. That is because the securities will generate less cash when sold than was originally anticipated, and because the sale often caused a reduction in regulatory capital. The increase in interest rates has also had direct impacts on banks' income and expenses. In 2022, bank results, we are seeing the typical near-term boost to bank income from higher interest rates and interest rate banks can pay on deposits tends to lag in the market. So, for example, if you were to put your money in a bank, maybe you're getting, depending on the account, I mean, if you're in a CD, maybe you're getting 4%. But if you're in just a normal bank account, maybe you're getting 1/10 of a point, 1/4 of a point, 1/2 a point. You're getting very little interest. But if you were to put them in short-term T-bills, you might get 5%. So if you put 100 grand in T-bills, 100 grand in T-bills at short-term T-bills 5%, you're making $416 a month. That's a lot of money. That is a lot of money just to let your money sit, right? And so we're starting to see people pull money out and put them into, a better vehicle that's going to generate a better return. Over time, however, as market interest rates increase, banks will likely need to pay more interest to retain their deposits or accept depositor outflows. So far, though, year-end 2022, we have seen modest decreases in total deposits and most increases in insured deposits. Now, people think that their deposits are fully insured. FDIC, they have enough to cover about 1%, of deposits. So your money's not fully FDIC protected in the event that things actually really did hit the fan. In aggregate, meaningful deposit outflows have not yet materialized, but banks will need to watch these trends carefully as interest rates environment evolves. A complicating factor for banks that hold significant amounts of longer-term assets that increase in market interest rates can cause gradual negative earnings impacts over time. Specifically, assets that were acquired when interest rates were lower are now earning below market interest rates. This reduces the net interest margin below what could otherwise be achieved. For that reason, some banks may choose to sell depreciated assets, realize the loss, and replace the sold asset with a new higher yielding asset. The bottom line is that planning a bank's funding and investment in a way that is both prudent and profitable is a complex and challenging task at a time, especially when interest rates changing to the extent that they have over the past year. The management of interest rate risk is important to all banks. Is in an era of ongoing supervisory focus on the FDIC. I'll leave this, I'm not going to read the whole thing, but I'll leave this in the show notes. They dive into all the risk that they're stepping into right now. This is absolutely getting out of control. You look at SVB Bank, this went bust. This just went bust. Peter Thiel, all these different VC firms, all these different investors, everyone's pulling the money out, right? There was a capital call. They were just saying, get your money out of this bank. And so they just rushed to the floodgates and they got their money out of the bank. Same thing with Silvergate. Silvergate, a similar situation, crypto-friendly lender Silvergate collapses. This just happened yesterday. And as this is all going down, payroll rose 311,000. And they could go in and say job creation deaccelerated in February, but was stronger than expected despite the Federal Reserve's effort to slow the economy and bring down inflation. What does this mean? This means that they're going to continue to increase interest rates. And as that begins to happen, you're going to start to see the cost to service existing debt issued by banks get more expensive. Think credit cards, think auto loans, think commercial real estate. Everything is going to get much, much more expensive, and the weight held by central banks or by large commercial banks is going to I think get a little bit more challenging by the day. And if they do need to bail in and they need to get themselves out of a bad situation, they likely will. Look at delinquencies on commercial real estate loan rises sharply in Q4. We haven't seen anything just yet. Just wait until this thing really starts to get out of control and we start to see this situation. Right now, 20% of all renters in America are behind on rent. You think about it, all these real estate investors that bought these properties on floating rate debt, thinking rents are only going to continue to rise, are starting to see higher vacancies, higher expenses, higher insurance, higher property taxes, everything's getting more expensive, and then they're going to have to refinance from a 3% to a 7% loan. This is getting banks into a really bad situation. So if you do have all your money in a bank, maybe you want to split some risk. Maybe you want to put some money in other banks. Maybe you want to do something else, right? I'm not saying to do something crazy, but I'm simply saying weigh your risk. If you look at banks are not your friends. Banks are a business. Banks are there to make money off your money. They'll take your money and they'll lend it out at 5, 10, 15, 20, 25%. You think credit cards, that's what credit card interest rates are. They'll lend your money out and then they'll give you a 1/10 of a point. So I wouldn't be extremely loyal to one bank. I would weigh your options. What do you think about this entire situation? Drop it below, hit the like button. You think about this. Who's going to keep their money in a bank getting 10% of a point or a 10th or 20th of a point? Nobody. Nobody. If they have a $1 million, $2 million, $5 million, $10 million bucks, they're putting it into T-bills. You're going to get a bunch of small deposits, I think, over Q3 and Q4 that are just in the banks to pay off debts. And if they continue to increase interest rates and there's no QE, there's no money flowing in, we're going to start to see a real financial hell, I think, start to break loose in Q3 and Q4 of this year. So if you are planning on investing, you want to do something, I think there's going to be a lot of distress, and you want to be positioned, well positioned for it financially, so you can put yourself in a better spot. Because if we start to see this go down, I think things are going to get really, really bad. What do you think? Drop below, hit the like button, subscribe here on my second channel. If you need help fixing your credit, we'd love to help you at GreatCreditFast.com. You can give us a call again at 561-430-5900. We'd love to give you a free consultation. And you can subscribe to or follow me on Instagram for short form content. Catch you guys in the next video.